and we'd be looking at almost $250,000 annually in dividends. Hey, what's going on, YouTube? So today we're going to be talking about dividend investing and the compounding effect that investing your dividends back into your portfolio will do for the long term. This is a beautiful thing. This is one of my favorite things when it comes to learning more about dividend investing. So what we're going to do is actually hop over here on the computer. We're going to learn a little bit more. We're actually going to use my retirement account as an example for how this is going to impact us for the long term. I'm actually going to have it right over here on my dividend tracker. You can see right over here. So under my Vanguard, I have about $77,772. I believe it's currently updated as of this recording. And then I also have my wife's retirement account in the same Vanguard, but I had to split it up here. You can see hers is at $19,473. So let's go ahead and add these two up, and we're going to go ahead and show you some really cool things that are going to be impacted here for the long term. So we've been investing in these portfolios for quite some time now, and they've been building up, and I want to show you how impactful dividend investing can really be, and how even just a couple years can make a huge difference with how much you're going to be making in dividends. So in total, you can see we're going to have $97,245 combined between both of our accounts. Now, what we're going to be doing is using a calculator, plugging these numbers in, and seeing those effects. So one of the things we're going to also look at too is our dividend yields. Now, for our retirement accounts, they are a little bit more heavily focused on growth right now, but they still pay out dividends. But I want to show you the impact that it'll still have, even though we're mainly focused on growth in the retirement account, where as we get closer and closer to retirement, if these numbers don't come to fruition, we will probably sell them and invest directly into companies that pay out higher yields on dividends. But I'm going to show you what this means. So right over here, you can see on my version of the account, my current yield, if you bought into my portfolio today with the same amount of money, would come out to 0.92% yield, pretty low. And you can see my yield on cost is actually 1.48. The difference between that is effectively the raises in dividends over the last couple of years since I've had my account in, or my money in this account. And so that's really powerful that most people don't talk about. Most people don't talk about those dividend increases that happen year after year, because you are actually making more money on the money that you're getting paid out because of those increases. So let me check something real quick, and we're gonna go ahead and do a couple different plugins for these numbers. So again, remember, I have mine and my wife's account. So if we swap over really quick to my wife's Vanguard, again, 0.93% yield if you got into hers. I think it's based off of the percentages is why hers is a little different on the yield, because I have one extra fund. And her yield on cost, because she got started a little later, is at 1.15% yield on cost. So what we're going to do is plug these numbers into our dividend calculator. Let's see what we can have an impact on. So remember, if we go back here, so our starting principal is $97,275, right? Was that it? 245. Okay, well, that's close, but let's just go and fix that. And I added a zero on there too. All right, so we have $97,245 as our starting principal. Now our annual dividend yield, remember, we actually have two yields here. We have a 1.15, and then we have, let's add this up here, 1.48 yield. So divide this by 2, so we get an average between the two is 1.31. So what I'm going to do is plug in our current dividend yield right now, which is the, let me move this off screen here for a second. So it's going to be 1.315. It's going to ask in this calculator here if our account is a taxable account. Now, since this is our retirement, this is not a taxable account. So we're going to go ahead and click on no here for now. Now, our annual contribution, now because this is an official IRA account, what we're going to be doing is having limitations on what we could put in, and it's $6,000 per account, so it's $12,000 a year. I don't know why the zero keeps staying in there, but $12,000 a year. Now, obviously, over the years, this might increase as far as our contribution limits, but we're just going to stick with the $12,000 a year every year. And then right over here next, this is going to be an important one. So this is the expected annual dividend increases per year. Now, this is a little harder to calculate exactly how much this is going to grow over time, but I'm going to show you just one quick example. We're going to hop over here on seekingalpha.com. Just want to make sure everything is on screen here. Okay, looks good here. So what we're going to do is look at our main our main fund that we have, which is technically VOO, but it's under a different title on Vanguard for now. we're going to go to its dividend scorecard and we're going to look at the 5-year average. So over the last 5 years, on average, this stock has increased, or this fund, I should say, it's not a stock, it's a fund, ETF. So this right over here has grown on average 5.72% over the last 5 years. So we're going to use this number here as our example for growth. So 5.27%. And then how often it's distributed is quarterly. Dividend tax rate, we'll just leave it at 15% for now. And then expected annual share price appreciation per year. So right now, I believe the S&P 500 averages, obviously the last year's been way off, the norms, but I believe it's about 8 to 10% per year. Let me go back to the calculator. Let's be a little conservative here and let's just do 8% annual price growth on there. And then DRIP right over here, in case you don't know, this stands for Dividend Reinvestment Program. This is massive when it comes to learning about compounding your investments, because I'll actually show you the differences between using the DRIP and not using the DRIP. And effectively, not using the DRIP means that anything you get paid out as dividends stays in your account without being reinvested. And that means that your money is not working as much for you. And I'm going to show you how impactful that is, as well as show you a couple different time periods as far as like 20 years, 30 years, maybe even 35 years, because as the time keeps adding up, every year just keeps compounding so much more, and it's crazy. Well, I can't wait to show you this. So we're not going to worry about the tax exempt stuff, and then what we're going to do is let's just go right now and just kind of start off a little small. Let's go with 15 years. Now, I do have a goal with my M1 Finance portfolio, which here on the channel, I actually go over, so you guys can hit subscribe and follow those videos too. I actually go over investing for the next 15 years because I do want some money when I'm like 45, 46 years old. But this money that we're using here today with examples with my portfolio is for retirement, which is actually 28 years away for us. But we're going to start with 15. I just want to show you step by step how this is going to impact us. So let's go with calculator. We're going to get some of our fun ads that pop up every single time here. I'm just actually waiting for it maybe beforehand. No. Okay. It's going to come up. There it is. So in 15 years, it's estimated, these are all estimates, got to keep reminding people about that all the time. We're going to have about over $750,000 in this account. And our annual dividends should be about almost $22,000 every single year between the accounts combined. That's really good, and that's in 15 years. And we, again, don't need this money for another 28 years. So this is really cool, right? So this is still a really solid amount of money. I mean, we're getting close to almost $2,000 a month here in dividends that are gonna be getting paid out. Now, granted, they're paid out quarterly, so you just break it down, but still, nonetheless. I want to show you how impactful, because we're talking about compounding, right? So we're going to go and do 28 years. So this is what we're going to need to be able to, when we're able to start pulling money out of these accounts. Because again, these are our retirement accounts. So 59.5 is when we can start withdrawing some of it. But obviously we don't have to, but we can. And I'll show you what this is all impactful for. So we're going to hit calculate here. So while the ad here is, I'm waiting for that to load up, I do actually want to swap over really quick to our other page here with our company that pretty much helps us out, continue to provide free content like this for you, which is with Earnest. If you have student loans and you are maybe paying some really high interest rates, check out our friends at Earnest. You can actually refinance your student loans entirely for free. And within 2 minutes, you can find out if you are actually paying more than you need to for your student loans. And here's the best part. Is with that money you can be saving every single month from your student loans, you can use that to pay more into your investments. I love talking about that because that's huge and that's impactful for you. And the really nice thing is Earnest has actually worked with us to be able to give you a $100 bonus if you actually check out the link down below and go through the process of refinancing your loan. So not only is it free, not only can you potentially be saving more money off of the interest, you actually can get a $100 bonus if you end up going through that full process. So click the link, you'll go to a page that looks exactly like this. Just click on the get your rate and then see what that process is gonna be like for you and save that money. So let's go back to the calculator over here. So we had everything run. Check this out. It still came up either way. So give or take, at the end of 28 years, we would have $3.4 million between the two accounts. And our annual dividends would be almost $200,000. Think about that. From 15 years to 28 years, the difference between those two, almost $200,000 annually we're going to make. So let's break that down real quick, because I kind of am curious how much that would be per month. And divide by 12. That would be on average almost $16,000. Now this IRA mine is actually a traditional IRA, so we're saving the tax money now, and my wife's is actually a Roth right now, so it's growing tax free. So there's kind of like on both ends there. So some of that money is going to be taxed, so keep that in mind. But $16,000, and keeping up with inflation, kind of consider that too. That's huge. Now, because we're talking about compounding, features when it comes to dividend investing, I want to show you how impactful this is when it comes to not reinvesting these dividends, which would be cray if you didn't reinvest it, especially in a retirement account, because that money's just going to sit in there, right? Because you can't withdraw it. So let's say you didn't reinvest these for that 28 years. Check this out. You'd only be at about $2 million, and your annual dividends would only be, and again, I'm using the word only, right? $112,000. Look at that huge difference for not reinvesting those dividends. That's the power of compounding interest when it comes to dividend investing. Now, keeping in mind that when it comes to investing for retirement, 59.5 is when I can be withdrawing, but I don't have to. So let's say I waited another 2 years, just two years, right? From when I can withdraw, just 2 years. I'm gonna show you how crazy this starts getting. I'd be looking at about $4.4 million, and we'd be looking at almost $250,000 annually in dividends just by waiting 2 more years. Just 2 more years. That's crazy impact when it comes to compounding your money for the long term with dividend investing. Now, what I want you to actually do next is click this video right over here, because I want you to keep learning more about dividend investing and the power it can have and how it can change your life for the long term. So by watching more, you're going to keep on learning. My name is Dennis, and I'll see you in that next video.